This past week in the market was a perfect example of what I have been stressing for years, and that is that bottoms in real time never look like a bottom, and tops in real time never look like a top. So this is the market as of the close last Friday. And I can tell you that the sentiment on the premium site was about as bearish as I have ever seen it. Everyone knew that the market was ready to, at a bare minimum, we were going to undercut this low and make a lower low. We were going to break this support. A lot of people were convinced that an 87 crash was imminent. The technical indicators were all bearish. We're oversold on RSI. MACD is rolled over. ADX red is preparing to move above black. Stochastics moving down into oversold. Without a doubt, this is a bearish chart, and I would say at the close on Friday, pretty much everyone knew exactly where the market was going this past week. It was going to go down. I tried to warn people that again, that bottoms don't always, they just don't look like a bottom in real time. And what was happening in real time is we were getting a retest of this low. And as of Friday last week, the retest was successful. And even though this looked very bearish, this had not broken below this low at that point. So other than looking bearish, there was no confirmation that this is a bearish chart that was preparing to make a lower low. So now let's fast forward 1 week. And what a difference a week makes. MACD has turned back up. Red ADX is on the verge of crossing below green. Stochastics have emerged from oversold and are now moving back up towards overbought. RSI is overbought. And I've noted this many times in the past that the advancing phase of an intermediate cycle will generally rally pretty quickly from oversold conditions. So if we were in the declining phase of an intermediate cycle, we would expect this oversold level to stay oversold for an extended period of time. That's how the declining phase of an intermediate cycle works. And you can see this vividly right here. This is the declining phase of an intermediate cycle, oversold for a long period of time. A brief bounce, can't even make it back to overbought, and then back down into oversold conditions again. Classic pattern during the declining phase of an intermediate cycle. Now we have the exact opposite. We've got a brief move into oversold conditions, and that has spawned a very powerful, and this week, this rally of this week was the most powerful rally of the entire year. So this is behaving like the advancing phase of an intermediate cycle. So even though we have retested the low, and even though everyone on Friday of last week was convinced that the low was going to break, and we were possibly starting a 1987 crash, the stock market has topped, we're entering a bear market, none of that came to pass. Instead, this turned out to be a bottom. And we are now following the typical pattern that we see during the advancing phase of an intermediate cycle. And so if you listen to the perma bears, they will give you 101 reasons for why the stock market should not be at these highs. They'll give you, multiple reasons for why we're starting a bear market. And as of today, the market refuses to validate any of them. You can see we have a higher high. The September high was higher than the January high. We've got a higher low, at least as of the end of November. This low was higher than the February low. The October low was higher than the April low, and the November low has held above the October low. This is the definition of a bull market: higher highs and higher lows. So there is absolutely no evidence at this time that we have begun a bear market. In fact, we've got multiple confirmations that we are still in a bull market. We are still making higher highs and higher lows. We have a retest of this intermediate cycle low, exactly the same as the retest in April of this intermediate cycle low. My expectation is this was a very long, from February until the top in September, bottom in October, very long intermediate cycle. Usually a short intermediate cycle will follow a long cycle. So I suspect what is probably going to play out is we're going to get a rally probably through December, maybe into January, possibly even into the beginning of February. I think we'll probably make another marginal high, but I still think we're stuck in a difficult sideways consolidation. So months ago, I noted that the NASDAQ had reached 8,000, actually a little above 8,000, but at the time I noted that it was too late in the intermediate cycle to expect a sustained breakout, and I suspect that we're still not ready to get a sustained breakout above either one of these peaks. So I think best case scenario, we probably come back up, maybe make a marginal new high. A full test of 3,000 is a logical spot. I doubt that the market would get through 3,000 on a sustained basis, on its first try. So my thinking is that we get a nice rally for the next 4, 6, maybe 8 weeks tops. Probably break out above this high and prove the perma bears wrong again. Maybe get to 3,000, and then I think we've got another very scary correction ahead. All right, so looking at a longer term chart, you can see that easy periods in the market are almost always followed by difficult periods, and difficult periods are followed by easy periods. We're in a secular long-term bull market. You can see we had a very difficult period here during 2011, well into 2012. Once we got through that difficult period, we had a nice trending move, and then we enter another long extended basing period, difficult trading conditions, the consolidation that works off this big trending move. That is followed again by a very powerful trending move, and we're now again stuck in a difficult consolidation period as we work off this big powerful rally. And I suspect we're probably not done with this just yet. All right, so I think I've noted this before. An intermediate decline usually has to break the intermediate uptrend line. At first I thought this line was probably a little too shallow, and I tended to want to draw my line through these two pivots, but remarkably, we did come down far enough to break this trend line. So this was a very shallow trend line, and with this recent retest, we've got another fairly shallow trend line that is going to form for this intermediate cycle. So this has ramifications, I think. So my expectation is over the next 4 to 8 weeks, I think we come back up. At the very least, I think we get a very close test of this, and I think we're probably going to break above it and test 3,000. But again, I think we've got more work to do, more consolidation, more difficult trading before we're ready for the next big trending move like we had here. So I doubt that the S&P is going to be ready to break through on a sustained basis through 3,000. So I suspect we'll get up here. Everybody will get ultra bullish, just like everybody was ultra bearish here and here. And then that will be the fuel to drive the next scary correction that comes back down and should break this intermediate trend line, which, as I've noted, is fairly shallow again, not quite as flattish as this one, but still breaking this sometime in February. That's my expectation for the intermediate cycle low, February, March, roughly the same time frame as this one here. If we go to 3,000 and then come all the way back down here to break this trend line, it's going to be another very scary correction. The perma bears will be out again, just like they were here. Just like they were here, they'll be calling the top of the bull market. And as long as the pattern of higher highs and higher lows continues, then they will continue to be wrong. And possibly at that point, once we get the next intermediate cycle low, then I think we could possibly be in a position to get a rally that could give us a sustained breakout above these highs here, and a big run to the upside that would put in the top of this 4-year cycle, and then we get our cyclical bear market probably towards the end of 2019 into 2020, and we may not even have a recession at that time. Recessions are caused by inflation, specifically a big spike in the price of oil, something that collapses the middle class discretionary spending. I'm not sure that we're going to be into those kind of conditions by 2019 or 2020. So the move into the next 4-year cycle low may just be something along the lines of what happened in 1987. The market just got stretched way too far above the long-term moving averages, and it needed a severe regression to the mean event to pull back to the average. And we didn't have a recession in 1987, even though the stock market produced a cyclical bear market, at least in name, but it did not correspond with the recession. And we may have the same thing in 2020, a very hard pullback, something 20% or more, but maybe not associated with an economic recession. So I'll urge people again, you need to ignore the perma bears. They've been trying to call a top in this bull market for years, and the simple fact that the market keeps making higher highs and higher lows attests to the fact that we are not in a bear market, and until that pattern changes, we are still in a bull market, and this needs to be traded as a bull market, which means you need to buy dips and not short, not short or try to short the market. That's not a winning strategy in a bull market. Trying to pick tops is just not a winning strategy.